Good morning. I'm Richard Shepherd-Cross, Investment Manager to Custodian Property Income REIT. In the next 20 minutes, I hope to tell you a little bit about Custodian's strategy and how I believe investors should assess the relative worth of a UK real estate investment trust like ours. The headline numbers show a market cap of 415 million, with annual earnings of 5.6 pence per share, supporting a fully covered dividend of 5.5 pence, with gearing of 27.4. Custodian's a proudly diversified fund, diversified to reduce risk and to remain relevant in all market conditions. We saw in 2022 some of the most popular sector-specific funds experiencing huge swings in share price, which as a diversified fund, we were less exposed to. The chart on the right shows how the income of the portfolio is weighted, 40% to industrial, 24% to retail warehousing, etc. And we'll talk about the relative growth prospects for each of these sectors in due course. We specialize in smaller regional property, and by smaller I mean sub £15 million. We're not talking corner shops or workshops under the arches. Our properties are all modern, let to nationally recognised tenants in strong commercial locations. And we focus on this sector of the market to drive superior returns, and more on that as we go through. Ours is an income-focused strategy. As the principal component of total return from real estate, it makes sense to us to build a strategy with income at its heart. And we pay dividends fully covered by earnings because we believe that that's appropriate, and also because it's sustainable. We invest for the long term, investing in the portfolio through refurbishment, bringing forward new environmental improvements to keep the properties up to date and in demand from occupiers. So let's consider for a moment what Custodian Property Income REIT is worth to investors. As I said, Custodian is an income-focused REIT, and I believe that income supported by earnings is a much better measure of worth than net asset value. If you look at the chart, the blue line shows the path of net asset value over the 2 years from March 2021, and the grey line, the share price. As you can see, property valuations ran away in 2022 and fell back sharply in Q3 and Q4, but the share price didn't track net asset value, sticking much more closely to a multiple of earnings, showing an earnings yield in March 21 of 6.1% and 6% today. The red line shows the consistent earnings per share of between 5.6 and 6 pence over the 2 years. And I think it's time we followed the lead from the US and stopped fixating on net asset value and started to analyse UK real estate investment trusts by reference to earnings per share. However, it's important to look a little deeper than earnings per share alone. The equivalent yield of the property portfolio is a key metric and the central measure of value we use in assessing the investment potential of any property in the portfolio. As the chart shows, where the equivalent yield is ahead of the net initial yield, then there's rental reversion to come. Across the whole portfolio, there's £7 million of reversion, £7 million of reversionary potential, and much more to unlock through asset management over time. Rental growth is the headline news that doesn't always seem to make the headlines, but it is and will be the best news story for commercial property investors looking for long-term real returns. It won't surprise you in looking at these numbers that there is still a modicum of overrent in our high street retail assets. But even here, we're starting to see stabilisation and some growth in prime high streets. Retail warehousing has been a target sector for us for some time, and it demonstrated extraordinary resilience through the pandemic, particularly in our favoured subsectors of food, homewares, DIY, and the discounters, vacancy rates are low, and occupiers seem to be able to cope with an amount of rental growth. In the office sector, there's a much clearer picture emerging of how we will use and occupy offices in the new world of hybrid working. Occupiers are demanding much higher levels of amenity from their offices and from their office locations. And this favours modern, flexible office space in city centre locations with strong transport links and with high environmental credentials. Where this space can be provided, there appears to be meaningful rental growth. But conversely, office space that cannot meet this tenant demand could become obsolete and need to be repurposed. In our portfolio, we've seen strong rental growth in Oxford and in central Manchester, where we are currently refurbishing offices to meet this new market demand. The real powerhouse of rental growth is in industrial and logistics, a sector which accounts for 40% of the custodian rent roll. In many regional markets, rents are still around £5 a square foot. Lack of supply, limited development, and the construction cost inflation have all combined to see rents for new build regional industrial units to be regularly upwards of £10 a square foot. And well-specified refurbished space is also seeing rents of £7.50 to £10 a square foot. And this is providing significant latent rental growth across the custodian portfolio. And you can see this in the equivalent yield. In this market, balance sheet strength is very important. I've often commented that no property business has ever failed from owning too much property. It's always too much debt or the wrong sort of debt that topples a property company. We have relatively long-term debt, and as you can see from the chart, 3 tranches of fixed rate debt and a revolving credit facility, giving a weighted average cost of debt of 3.7% and a weighted average maturity of 6 years. And at 3.7% against a portfolio net initial yield of 5.8% with reversion, you can see that this debt is accretive to earnings and supports our income-focused strategy. Now, I understand that it's my absolute responsibility to deliver absolute returns to shareholders. But in 2022, with economic headwinds and the volatility in real estate markets, I thought it's fair to consider Custodian's relative performance. And I think it speaks volumes about our income-centric diversified strategy. The share price total return for UK listed real estate was reported by Jefferies to be negative 34% in the 12 months to December 2022. And some of the sector-specific REITs suffered over 40% negative share price total return in the same period. Meanwhile, Custodian saw only a negative 2% share price total return. And I think this is reflective of the price not getting carried away on the upside and the price sticking much more closely to earnings denominated metrics rather than chasing net asset value. Over the year to March 2023, our smaller regional property strategy has also seen less volatility in property valuations than the market as a whole, down 13.6% against a market decline of 17%. And much of this outperformance can be attributed to Custodian's investment strategy. And as I've said here, we believe that small is beautiful. And we specialize in that smaller regional property where we believe we can capture additional income without adding to portfolio risk. This alchemy is perhaps best explained by considering the chart on the screen in front of you. The chart, based on whole market data, looks at the 1-year rolling average transaction yield for properties traded in the market with lot sizes of less than 10 million, shown by the dark blue line, and greater than 10 million, shown by the light blue line. As you can see, from 2000 to 2010, there was a fairly narrow and consistent margin of about 75 basis points. Let's call that the risk premium for smaller lots, although much of that premium is just the hassle factor of managing smaller lots. So what happened in 2010 to see that margin open up as it did? In 2010, post-global financial crisis, back into the market came the open-ended property funds, UK pension funds, and overseas investors in the form of both private equity and sovereign wealth funds, all pursuing relatively similar strategies of prime large lots. The pressure on a limited supply of these large prime properties caused prices to rise and yields to fall. But at the same time, many of those same investors were divesting of their smaller lots, feeling they didn't get enough bang for their buck from managing the smaller assets. And so we saw an increase in the supply of smaller assets without that being matched by demand. So rather than a change in the risk profile in large versus small lots causing this divergence in yields, what we're actually seeing is a change in the supply and demand dynamics that has opened up an average 150 basis point margin. However, if the risk premium, and I've already given you my view on how much of that is risk premium, but if the risk premium is 75 basis points and the margin has grown to 150, that suggests there is 75 basis points of additional return for taking no additional risk. And it's this marginal income from the smaller regional properties that support higher earnings and fully covered dividends of Custodian Property Income REIT. Risk is further mitigated through a smaller lot strategy by virtue of the number of properties and tenancies in the portfolio. With 165 properties and over 300 tenancies, we have no single property in the portfolio let to any one tenant that accounts for more than 1.5% of the rent roll. That is genuine risk mitigation. And if you consider the top 10 tenants in the portfolio, they represent only 22% of the income, and that is spread across 28 properties, as you can see from this chart. Furthermore, the portfolio is diversified not just by tenant, but by property, by sector, and by geographic location. We firmly believe that there's no need to sacrifice the quality of the property, location, or tenant by buying smaller assets. And with smaller properties, we also benefit from having a higher share of the value in the bricks and mortar, the vacant possession or residual value. This is in no small part due to the fact that there is both an owner-occupier and an investment market for many of the smaller properties that we own. And this provides a floor to the valuation of our properties, which doesn't necessarily exist for larger assets. One of the misconceptions of a smaller property strategy is that we have lower quality tenants, but this is absolutely not the case. Indeed, the vast majority of our tenants are nationally recognized names. And as you can see from this chart, 74% are considered by Experian to be low-risk tenants and nearly 90% lower than average risk. One question I'm often asked when looking at this chart is about the tenants who are classified as imminently failing, which seems a pretty cruel moniker. However, we see real opportunity in this category because it is almost always the case that for those tenants who are imminently failing, they've been struggling for some time. And when they fail, it provides an opportunity for us to take control of those assets, refurbish them, bring them back to a modern specification, and let them to much better quality tenants at higher rents. Which leads us neatly to consider asset management, which is a 365-day-a-year role with many and varied opportunities to enhance the properties in the portfolio, to pick up rental growth, and to improve the environmental credentials of assets. Time was when we considered the environmental impact of real estate and the management of the portfolio as separate issues. However, it's now central to the asset management of the portfolio, with the moral imperative, legislation, and importantly, financial advantage all pulling together to keep our focus on improving the environmental performance as measured by the EPC of each and every property in the portfolio. And you can see the ratings of the portfolio in this chart. Happily, our efforts in this regard are reflected in greater tenant demand, additional rental growth, and increasingly that environmental factor is reflected in valuations. Two recent examples of the work we've done. At the smaller end, in Leicester, a former Pizza Hut, which we repossessed after Pizza Hut, who were an imminently failing tenant, put themselves into a company voluntary arrangement. We have subsequently refurbished the building, added a drive-through lane, improved the EPC from a D to an A, and let it at a higher rent to Tim Hortons as a drive-through coffee shop. And this has doubled the value from £1 to £2 million. On a slightly larger scale, we are currently redeveloping an industrial unit in Redditch from the 1980s unit you can see on the left, which perhaps had a maximum achievable rent of £5 a square foot, to the unit you can see on the right, which will be a BREEAM excellent rated high bay distribution unit. When we planned the redevelopment, we did so on the basis of a target rent of £8.50 a square foot, which would have delivered a profit of around £2 million. But such is the market, we now expect to achieve more than £10 a square foot. So as you can see, both of these are examples that demonstrate that improving the quality of the portfolio through the judicious refurbishment and upgrading of the environmental performance is, for shareholders, a profitable business. So what comes next? Values appear to have stabilized, not least on the back of a more optimistic forecast from the Bank of England on interest rates. The economy appears to be dodging a recession, and there's still plenty of money chasing the real estate sector. Real assets and real returns delivered on the back of rental growth are attractive in an inflationary economy. We expect to grow the rent roll through both continued asset management and from picking up that rental growth at lease renewal and rent review. But also over the next 12 to 18 months, we've identified a pipeline of £28 million of investment into 23 projects across the portfolio, which we expect to yield a £10 million profit, as well as the attendant benefits that come with improving the assets. And we expect that the Custodian property, smaller regional property strategy will continue to provide enhanced risk-adjusted income to shareholders. Thanks very much.